Okay, tax pros, there's been quite a few updates to the tax laws this year. At TaxSlayer Pro, we want to make sure you have the knowledge and the tools to be the best in the game. So buckle up. Here's the rundown on tax law changes for 2020. In the Consolidated Appropriations Act, Congress extended many provisions retroactively to the 2018 tax year. These aren't new, but they do expire at the end of 2020, so it's good we be aware. We've already included these in our 2018 and 2019 tax programs, but let's go over some details. In the game, we call these provisions tax extenders. Here's the list. First up, tuition fees and deductions. The mortgage insurance premium, which is part of the mortgage interest deduction. All federally declared disasters are being treated as qualified disaster loss for EIC recalculation and casualty loss treatment. This extender is unique because it only applies to disasters that the President has designated by February 18, 2020. The qualified person residence indebtedness, which is eligible for tax attribution treatment on Form 982. This extender refers to reporting of debt forgiveness on the tax return that occurs when an individual's home is foreclosed and the bank takes back the residence and sells it for less than what was owed. The residential energy credits, commonly used for home improvements. The most impactful changes involve retirement plans and distributions. Basically, more employees are eligible for retirement plans. As a result, taxpayers will see various types of distributions. In 2020, under the CARES Act, up to $100,000 of coronavirus-related early distributions from a retirement plan are not subject to the 10% additional tax that generally applies before the age of 59 and a half. In addition, up to $100,000 in a coronavirus-related distribution can be reported as income in equal installments over a 3-year period, and an individual has 3 years to repay the distribution to undo the tax consequences of the 2020 distribution. Effective for all tax years after 2019, the age after which a required minimum distribution from certain retirement accounts must begin has been raised to 72 from 70 and a half. Starting in 2020, any taxpayer who has not turned 72 by the end of this year does not have to make a minimum distribution. This is a permanent change to the tax code. Also, due to the CARES Act, no one is required to take a minimum distribution this year, regardless of their age. New rules require workers over 70 and a half to offset any deductible charitable IRA contribution made in the year by the aggregate IRA contribution deductions allowed to them after they turn 70 and a half. In other words, the taxpayer cannot take a tax deduction for contributing to their IRA and then take a charitable IRA contribution in the same year. This is a permanent change to the tax code. Each parent can withdraw up to $5,000 as a penalty-free distribution from qualified retirement plans and IRAs for births and adoptions. This withdrawal must occur within 1 year of the birth of the child or placement of the adoption. Starting with individuals that passed away in 2020, the non-spouse beneficiary of their IRAs or other qualified retirement plan will have 10 years to withdraw all the money from the inherited account without penalty. Another area affected by the CARES Act is charitable deductions. Basically, the ability to make donations has been increased for 2020 as a response to the coronavirus outbreak. Individuals can deduct any cash contributions made to qualified charitable organizations up to 100% instead of 60% of their adjusted gross income, AGI. Corporations can deduct up to 25% of their taxable income for any cash contributions made to qualified charitable organizations. Deductions for cash donations were previously limited to 10%. When preparing 2018 or 2019 returns, taxpayers that are subject to a tax on a minor's investment income had the option of using two alternative methods to computing the kiddie tax. One method was to tax all income for certain minors over $1,100 at estate and trust tax rates. The other method, which will be the only method allowed in 2020 and forward, is to exempt from taxation the first $1,100 in investment income. The next $1,100 is taxed at the child's rate, typically 10%, and the balance is taxed at the parent's marginal tax rate. That covers the changes to the 2020 tax code, all part of TaxSlayer Pro's goal of keeping preparers informed and able to grow their businesses. Start your free trial today at TaxSlayerPro.com.